Have you ever pondered on the mystical dialect of the financial realm? It might appear that terms like stocks, bonds, funds, and equities are a foreign language reserved only for the Wall Street wizards. But in reality, they are not as convoluted and obscure as they might initially seem. It's understandable if you feel that these terms are a complex maze of economic jargon, a language seemingly locked behind an impregnable fortress of financial intellect. However, when viewed through the correct lens, it becomes evident that the world of finance is a fascinating landscape filled with opportunities. Let's take stocks, for example. They are a type of investment that represents a share in a corporation. When you buy a stock, you essentially become a part owner of that company. Stocks provide the potential for profit through capital gains, meaning if the company does well and the value of the stock increases, you'll earn more than your initial investment. Bonds, on the other hand, are a form of long-term loan you give to a company or the government. In return, the issuer promises to pay you a specified rate of interest during the life of the bond. This interest is often paid semi-annually and is known as the coupon. Upon maturity, the issuer repays the original amount of the bond, also known as the face value. Just as colors become a beautiful painting in the hands of an artist, these financial instruments become a wealth-building portfolio in the hands of an investor. Each instrument carries its own unique potential and risk. They are tools, and like any tool, their effectiveness depends on how they are used. So if you've been feeling overwhelmed by the jargon, don't. It's time to tear down those walls of confusion and intimidation. It's time to arm yourself with knowledge and begin your journey towards financial literacy, and independence. And now, as we bridge the gap from theory to practice, we transition seamlessly into the realm of ownership. What does it really mean to own a piece of a company? Let's delve deep into this intriguing world of finance to find out, shall we? Imagine owning a piece of a company. Not a physical piece, of course, but a financial stake. That's essentially what a stock is. A stock, in its simplest form, is a representation of ownership in a company. It's like having a taste of the corporate pie. As a stockholder, you are purchasing a share or portion of a company, making you a shareholder in that organization. A shareholder is an individual or institution that legally owns one or more shares of stock in a public or private corporation. When you buy a stock, you're not just purchasing a piece of paper or a digital entry on a screen, you're buying a tiny sliver, a minute fraction of a company. This is an exciting thought, isn't it? The moment you make that purchase, you become more than a customer or a bystander. You're becoming a shareholder, a part owner of the company. You're getting a claim on the earnings and assets of that company. The benefits of owning stocks are profound. You own a part of a company that could be creating groundbreaking products or offering cutting-edge services. As this company grows, evolves, and your investment grows with it, each step forward that the company takes could potentially boost the value of your investment. It's like riding a wave of success as the company thrives. However, it's important to note that owning stocks also comes with risks. If the company fails to meet expectations, or suffers from poor management, the value of your investment may decrease. This is the other side of the coin. It's not just about potential gains, but also potential losses. Ultimately, investing in stocks requires a careful analysis of the company's performance, market, and your risk tolerance. It can be a rewarding experience, but it's not without its challenges. So, tread wisely, and invest smartly. Well, now that we've taken a deep dive into the world of stocks, it's time to make a seamless shift into another significant aspect of the financial landscape. Bonds. Just as stocks offer a slice of ownership, bonds represent a different type of investment tool. But we'll get into that in the next scene. Stay with us as we transition into the captivating realm of bonds, a world full of intriguing possibilities and a different set of risks and rewards. Now let's delve deeper into the world of bonds. This financial instrument is unique in its structure and purpose. The stark difference between bonds and stocks is noticeable in their inherent properties. Unlike stocks, bonds do not grant the holder a part of the company in question. Instead, bonds serve an entirely different purpose. They are in some ways similar to a loan. Essentially, you are investing your money directly into an organization or a government entity. So, how does it all work? The process is simple, yet intriguing. When you purchase a bond, you are, in essence, lending your money to the issuer of the bond. This issuer could be a corporation needing funding to boost its business operations, or a government requiring financing to implement a public project. The issuer, in return, makes a firm promise to you, the bondholder. They promise to repay the principal amount that has been loaned, along with a predetermined rate of interest, over a specified period. But what makes bonds a worthwhile investment? One of the main reasons is the level of stability they offer. Unlike stocks, the returns on bonds are typically more reliable and steady. Furthermore, bonds present a lower risk compared to stocks. Even in scenarios where a company goes bankrupt or flops, it is still legally obligated to repay its bondholders, making them a safer bet. This is why many investors frequently include bonds in their portfolios. They offer a level of security hard to find with other investments. In summary, bonds may not offer you ownership in a company or entity, but they do guarantee a safer investment. Even if a company fails, bondholders can still expect to return their investment, making bonds a reliable and safer bet. But that's not all there is to know about bonds and stocks. Let's journey into our next scene, where we'll draw a more detailed comparison between stocks and bonds. An exciting exploration into the financial world awaits us. To delve deeper into our comparison, stocks as an investment tool represent a share of ownership in a company. Think of stocks as purchasing a slice of an apple pie. Now that piece is yours. This analogy is emblematic of stocks. When you buy, you're essentially acquiring a fraction of a corporation's total worth. This fraction provides you a ticket to participate in the corporation's progression and profitability. If the corporation thrives, the value of your share or slice increases. The more success the corporation experiences, the higher your potential gains. But beware, the corporation could also face a downfall which could devalue your shares, or even render them worthless. This is the point where the risk factor comes into play. Thus, investing in stocks becomes a gamble, with high potential returns but also substantial risk. On the other hand, bonds operate differently, more like a loan. Essentially, you're lending your money to a corporation or a government entity. In return, they promise to pay back the principal amount you lent along with interest at a specific maturity date. The charm of bonds is their stability. No matter how the corporation or government performs, you're assured of getting your original investment back with interest. Therefore, bonds are usually perceived as less risky. The trade-off, however, is that their returns are generally lower than that of stocks. To underscore our primary comparison, stocks offer a piece of ownership in a corporation, presenting higher potential returns and risk, while bonds resemble loans to a corporation or a government body, offering stability but typically lesser returns. Now, having looked at the nature of stocks and bonds, let's smoothly transition into our next scene, where we'll navigate the delicate art of balancing risk and reward in investment. Join us as we delve into how to find the perfect equilibrium between these two crucial elements in investing. In the intricate and expansive sphere of finance, the art of balancing risk and reward is a critical aspect of achieving substantial growth. In this dance of financial decisions, stocks and bonds emerge as two key players, each with its distinct benefits and potential drawbacks. Stocks, for example, offer the tantalizing prospect of high returns and expansion. They grant the investor a share in the company's ownership, which implies that if the company prospers, so does the investor. However, this opportunity is a double-edged sword. Stock value is intrinsically tied to the company's performance, meaning deterioration in the company's health can lead to significant losses for its shareholders. Bonds, in contrast, are typically seen as safer investment avenues. Essentially, they represent loans made by investors to organizations who in turn commit to repay the loan with interest. This arrangement ensures steady returns for the investor. Nonetheless, bonds are without their own hazards. If the organization declared bankruptcy, the investor might not recoup their investment. To navigate this financial maze, the secret isn't in favoring one investment vehicle over the other, but in comprehensive understanding. Understanding the personality, the benefits, and the risks associated with each instrument is paramount. With this understanding, the investor is able to construct a diversified portfolio that aligns seamlessly with their financial goals and risk tolerance. A well-diversified portfolio, comprising a mix of both stocks and bonds, creates a delicate equilibrium between risk and reward. It provides an ideal platform for investors to spread their risk across various assets while still ensuring potential growth. This diversification buffer helps to mitigate drastic losses and provides more stable returns over time. Understanding these financial instruments and their inherent risks and potential rewards empowers investors to make informed decisions. Through careful research and understanding, investors can strategically balance risk and reward to achieve their financial goals. Thus, in the dynamic world of finance, mastering the delicate art of risk and reward balance underpinned by a well-diversified portfolio, is the key to successful investing. And as we smoothly transition into our final scene, let us not forget how crucial financial literacy is in this context. It's the compass that guides investors through this labyrinth of choices, the beacon that shines on the path to achieving a balanced and rewarding investment portfolio. Remember, the journey to financial literacy is a marathon, not a sprint. It's a journey filled with twists, turns, uphill battles, and downhill glides. It's not a short, easy race where instant gratification awaits at the finish line. Instead, it's a long, persistent, and continuous voyage towards a better understanding of the economic world that surrounds you. Why is financial literacy so important? It empowers you to make informed decisions about your personal finances. It gives you the tools you need to successfully navigate the complexities of the financial world, to budget wisely, invest smartly, and plan for a stable, secure future. It equips you with the skills to avoid common financial pitfalls, like mounting debt and poor choices. Now imagine you're standing at the base of a mountain. That mountain represents your financial future, and climbing it is no small feat. You're equipped with the basics: understanding of savings and bonds, perhaps a rudimentary knowledge of economics. But that's merely the tip of the iceberg, the start of your ascent. As you gradually ascend this metaphorical mountain, you'll come across more complex concepts and financial instruments: mutual funds, commodities, derivatives, real estate, and cryptocurrencies. Each step takes you deeper into the intricacies of the financial market. You'll learn about market trends, economic indicators, and risk management. With every concept you master, your understanding of the financial landscape will grow, as will your confidence in navigating it. The journey to financial literacy is not without its challenges. You'll also encounter obstacles from economic downturns to personal financial setbacks. But each obstacle is a learning opportunity, a chance to reevaluate your strategy and grow stronger. Remember, it's not about how quickly you reach the peak, but the knowledge and resilience you gain along the way. But it's a crucial first step in taking control of your financial future. You're not merely learning for the sake of learning. This journey, this marathon, is about empowering yourself. It's about taking control of your money, your choices, and ultimately, your life. It's about ensuring that your financial future is not left to chance but is instead a result of educated decisions and informed choices. The pursuit of financial literacy is not just a journey but a lifelong commitment to financial empowerment.